your expectations from the Fed chair tomorrow, especially given some of the commentary we've heard so far?
Well, I think what he's likely to say in a Fed that is highly transparent, maybe not quite as much as it was under Bernanke and Yellen, but I think he will say that there is discussion, and I think they're going to be data dependent. I think the fact is we've had good jobs numbers. We've had mixed economic data that sides to the plus side for the economy. The resilience of the markets underscores that as well. Can't help but think there's a real chance here that we might not see a hike in September.
You mean cut?
I'm sorry, a cut. We're so used to saying hike, right?
I totally agree.
It's for decades.
Yes.
We've always been now it's
at least 1 decade.
It's the counter-inflationary trend that we have to watch. And the thought is here is that they likely don't need to, based on the economic data so far. And the weakness in manufacturing represents a small part of our economy. I mean, manufacturing is around 12% of our economy versus, other countries. Germany, 47 to 50% of its economy is export-driven, a lot of that tied to manufacturing. So our situation is decidedly different because of very important structural factors.
Mark, do you agree?
Well, I will say, in last year at Jackson Hole, Fed Chair Powell emphasized the importance of inflation expectations in determining monetary policy. And so with inflation priced in by the TIPS market at about 1.5% as far as the eye can see, my leaning is towards a Fed rate cut in September. And I do think this Federal Reserve has shown a hesitancy to surprise investors. So the fact that it's 98% priced in by the markets, to me, is a sign that a cut is likely next month.
John, what is your take on markets here right now, and what would you be, I guess, most aggressively buying, if anything?
Yeah, Morgan, I'd say the word aggressive will temper somewhat because of the fact that we've got the trade war rolling. But our expectations are that we are going to see a deal. In terms of the trade war, we think both the United States and China have big reasons, both from a position of economic growth as well as from pressure that the leaderships are feeling from business and consumer interests in both countries to make a deal. And we think that when that happens, we'll see things turned around. So we are decidedly favoring cyclicals versus defensives, and we've been that way for some time.
You counting on one before the election?
Well, we would hope before the election.
I know, we all hope.
Of course.
Yes.
But the thought is here also is just about every day you keep hearing of more companies diversifying their supply chain away from China. Now, China is very big on 5-year plans. And the more time it takes for that to build momentum, and it's not easy. The journal piece about Vietnam, and it's going to take time. But remember that when World War II started, the United States was decidedly unprepared to battle the Axis, and yet within 5 years they defeated Germany.
Mark, how are you positioning yourself, or how are you counseling investors to be positioning themselves right now in this market, especially in the fact that there is all this uncertainty, whether we're talking about the Fed, global economy, trade, all of the above?
Well, I do think there are times to invest more aggressively, and there are other times to be more conservative. And to me, given the heightened level of uncertainty today with, as you mentioned, the trade war with China, the upcoming election, the yield curve and credit markets, which are beginning to flash red in certain areas, to me, err on the side of caution. I will say, though, there's been a real flight to safe haven parts of the equity market, it's utilities in particular. And to me, those are no longer safe haven assets given their valuations today.